So Alphabet is basically printing roughly $132 billion in pure profit right now.
Yeah, it's a staggering number.
Right. And Wall Street is practically screaming at you to buy the stock. But, and this is the crazy part behind closed doors, their own CEO is just quietly dumping his shares.
Exactly. It's probably the single most pressing dynamic in the entire market right now.
Yeah, because you have two completely conflicting realities playing out on the exact same ticker symbol.
Right. It's like a split personality stock at this point.
And since today is April 14th, 2026, and we're looking at Alphabet, which is trading right around $323 a share today, we really need to figure out which reality is the truth.
We do, because the stakes are incredibly high for retail traders here.
Absolutely. You share this massive stack of sources with us, and your portfolio might literally be riding on this very question for the quarter. So our mission for this deep dive is to, cut through all that noise.
Yes. We're going to unpack those 2025 financials, decode the technical charts, which are wild, by the way.
Oh, they're insane. And we'll track exactly where the smart money is flowing and really just lay out the ultimate bull versus bear debate ahead of their next earnings call.
Sounds like a plan.
But first, a little to housekeeping. Please hit the like button on the video and subscribe to our YouTube channel and leave your comments and feedback below.
It's basically compulsory for the algorithm at this point.
Right, the algorithm demands it. But honestly, we genuinely do want to know what you think about this. Oh, and as always, just to explicitly state this up front, this is an intellectual exploration of your sources. It is not financial advice.
Definitely not financial advice. So to figure out if this stock is a trap or a gold mine, we really have to start by looking under the hood.
The fundamental engine of the company.
Exactly. The 2025 fiscal year financials. When you look at the raw data, the sheer scale of the cash generation is almost difficult to wrap your head around.
It is. I mean, they finished the year with over $402 billion in total revenue.
Which is just a massive jump.
Yeah, they were at roughly $350 billion in 2024. So adding, $50 billion to your top line in 12 months.
It's unprecedented for a company of that size.
And it translates to that $132 billion in net income we mentioned earlier, which brings their earnings per share near $11.
Right, $11 EPS.
And they're sitting on these massive cash flows, right? Like over $164 billion in operating cash flow and $73 billion in pure free cash flow.
It's a mountain of cash.
It really is. So on paper, the fundamental health of this company is graded by analysts as just great. It kind of feels like looking at a friend who just landed a job with this jaw-dropping lottery-level salary.
Yeah, but that is only half the ledger.
Right.
Let's look at the balance sheet, because that friend with the incredible salary, they just took out the biggest mortgage imaginable.
Oh, wow. Okay, break that down.
So Alphabet has total assets nearing $600 billion, $595 billion to be exact, but their total debt more than doubled in a single year.
Wait, doubled?
Yes. It jumped from about $22.5 billion in 2024 to over $59 billion in 2025.
I have to pause you right there, because this is the first major friction point in the data. If they are generating over $70 billion in pure free cash flow, why on earth are they issuing massive amounts of new bonds and doubling their debt?
Because of the pivot to AI infrastructure.
Okay.
Their capital expenditure, or CapEx forecast, is basically where this entire narrative hinges. Alphabet is projecting they will spend between $175 and $185 billion on CapEx for 2026 alone.
$185 billion.
Just for 2026.
Just to build out the physical hardware for artificial intelligence.
Yeah, and we really need to talk about what that actually looks like mechanically, because for the last 2 decades, Alphabet has essentially been a software company.
Right. Search, YouTube, Android.
Exactly. And software is famously asset light. You write the code, you deploy it globally, and your profit margins are just massive. But the AI arms race is forcing them to completely change their DNA. They have to become an infrastructure company.
Which is vastly more expensive.
Immensely more expensive. That $185 billion is going toward, securing massive plots of land, building enormous physical data centers, buying millions of custom silicon chips.
Laying the cooling pipelines, too, I imagine.
Oh, yeah. The thermal management is huge. And signing these massive, decades-long energy contracts to power it all.
So they're fundamentally changing their business model. They're shifting from this high-margin, asset-light tech giant into something that looks a lot more like a capital-heavy utility company.
That is the perfect perfect way to frame it. They are borrowing money even with all their cash because the upfront cost of building out this global AI physical footprint is just unprecedented. It takes years for a new data center to actually start generating a return on investment.
Which brings up a fascinating dynamic regarding how Wall Street is digesting this transformation, because you have this core business that is an absolute cash machine, but it's suddenly saddled with soaring debt for AI.
Yeah.
Yet the analyst consensus is just overwhelmingly optimistic.
The ratings are incredibly bullish.
Yeah, looking at the breakdown, we have 56% saying strong buy, 33% saying buy, 11% at hold, and literally 0% issuing a sell rating.
Nobody wants to bet against them.
Apparently not. The average price target is floating up around $354, with some banks like Mizuho projecting up to $420.
Right. The undervalued camp really builds their entire argument on the premise that this massive infrastructure spend is going to pay off exponentially. They point heavily to the PEG ratio.
Which is currently sitting at 1.3. Right?
Exactly.
And for those trying to visualize that, PEG stands for price to earnings to growth. It's essentially a metric that tells you if you are overpaying for a company's future growth.
Yeah, it contextualizes the PE ratio.
Right. A PEG ratio of 1.0 generally means a stock is perfectly fairly valued. So at 1.3, for a mega cap tech company leading an AI revolution, the bulls argue that is a massive bargain.
It is arguably very cheap, if you believe their growth projections, but there is a highly vocal, contrarian, overvalued camp out there too.
Their case.
Exactly. And they are using intrinsic value models that suggest the stock is actually 26% overvalued right now.
See, this is what makes the market so incredibly tricky for you as an investor. How can one sophisticated financial model tell you the stock is fundamentally cheap, while another model, looking at the exact same numbers, says it's 26% too expensive?
Well, it all comes down to how you calculate the long-term value of that $185 billion in CapEx we just talked about. I call it the commodity versus premium debate.
Okay, unpack that.
The models that say Alphabet is cheap are assuming that AI infrastructure will lead to high-margin premium software subscriptions. They think AI is basically the next iPhone.
A premium product people will pay a massive markup for.
Right. But the models that say it's overvalued, they view AI as electricity.
Oh, wow. Just a utility.
Exactly. A vital resource, sure, but ultimately a commoditized utility. If AI just becomes a basic expectation that every tech company provides, nobody is going to pay a premium for it.
Because it'll just be baked into everything.
Exactly. And in that scenario, Alphabet is overbuilding incredibly expensive infrastructure that will never command the profit margins they're used to. If AI is just electricity, the stock is a massive value trap.
That perfectly sets up the tension. If the models are deeply divided on whether AI is a premium product or a commodity, we have to look at what the people closest to the company actually believe.
Who have to follow the money.
Exactly. And if we follow the money, the actions of Alphabet's leadership are heavily contradicting Wall Street's strong buy ratings.
The insider selling data from the last few months is very illuminating.
It is practically a flashing siren. Look at this. In February and March of 2026, the CEO, Sundar Pichai, unloaded 32,500 shares across multiple transactions.
That's a significant offload.
It is. And what's really notable is the price. He was dumping these shares right in the $303 to $308 window.
Hmm.
And it wasn't just him.
Right, there were others.
Yeah, John Kent Walker, another major executive, sold over $14 million worth of stock. And the chief accounting officer, Amy O'Toole, has been consistently selling as well.
Now, to keep the analysis rigorous, we do have to acknowledge that insiders sell stock for many reasons.
Right.
They have taxes to pay, options expiring, or they simply want to diversify their massive portfolios.
True, but the timing and the sheer volume are what matter here. The CEO and the chief accounting officer are liquidating significant positions while retail investors are actively being told to aggressively buy the stock.
Right.
And we can actually see the other side of that trade when we look at the congressional trading data.
Yes. Looking strictly at the factual public disclosures and putting all politics entirely aside, Representative Nancy Pelosi made significant purchases of Alphabet shares.
In late 2025 and early 2026.
Exactly. But those purchases were made up in the $330 range.
Which is exactly the mechanism of the retail trap. You have the people who literally run the company taking their profits and exiting positions down around $305.
Right.
Meanwhile, high-profile politicians and undoubtedly thousands of retail traders reacting to Wall Street upgrades are buying the stock at $330.
It's true. When the people inside the building are selling at a discount and the people outside the building are buying at a premium, based on, optimistic analyst targets, it creates a very fragile market dynamic.
So if the CEO is quietly cashing out at $303, is the broader market sensing that same anxiety? Like, do the charts actually show structural weakness at that exact price point? Let's decode the technicals.
You have to, because the price action over the last year has been wild.
Yeah, we are talking about a massive 52-week volatility range, from a low of roughly $146 all the way up to a $349.
It has been a massive swing. Currently, the overarching trend is attempting a bullish rebound after spending late March in a consolidation phase.
Okay.
But to your question about that $303 price point, the technicals and the order flow actually explain exactly why the CEO chose to sell right there.
Okay, let's get into the mechanics of that, because I saw in the source material that $303 is considered a major structural floor for the stock. What does that actually mean in terms of trading data?
So it has to do with algorithmic order flow. Massive institutional investors think pension funds, hedge funds, they use algorithms to automatically buy a stock if it drops to a price that they consider fundamentally cheap.
Right, like a built-in safety net.
Exactly. And the data shows a massive concentration of these automated buy triggers sitting right above $303. It basically creates an invisible wall of buyer demand.
So the CEO wasn't just blindly selling into the open market. He knew there was a massive safety net of institutional cash waiting at $303 that could just absorb his millions of dollars in shares without tanking the stock price.
Precisely. He sold right into that wall of liquidity. And the charts show that if the price were to break through that safety net specifically, if it falls below $289, it would trigger a severe bearish breakdown.
Because there's no support left.
Exactly. There is very little support below that $289 level. On the flip side, though, your initial resistance right now is at $328 with a hard ceiling around $347.
Okay, but on the upside, the momentum indicators look surprisingly green to a casual observer. Like the RSI, the Relative Strength Index, is sitting at 71.65.
Which is pretty strong.
Yeah, and the stock is trading comfortably above its 5-day, 50-day, and 200-day moving averages. If a retail trader opens their brokerage app, all the dials just look bullish. But there's one specific metric, the MEC-ED, sitting at 1.30, that completely changes the narrative.
And this is where so many investors get caught. MEC-ED stands for Moving Average Convergence Divergence. Mechanically, it measures the distance between a short-term moving average of the stock's price and a long-term moving average.
So it's essentially measuring how fast the stock is moving recently compared to its historical pace.
Exactly. When the stock price surges too quickly, that short-term average pulls far away from the long-term average. The MEC-ED calculates that gap. A reading of 1.30 in the specific context is very high.
So what does that high reading actually mean?
It means the stock has accelerated so fast that the gap between those averages is stretched to its absolute mathematical limit.
Oh, I see. It's like a rubber band being pulled back as far as it can go.
Yes, that's a great analogy. And that state of being stretched is what we call momentum exhaustion. The stock might still be going up, but the underlying energy driving that upward movement is completely spent. That 1.30 reading is a massive warning sign that the rubber band is about to snap back.
And that is the anatomy of the retail trap in real time. A casual investor sees the green arrows, they see the price above the 50-day moving average, and they buy in at $323.
Thinking it's just going to keep going.
Right. They don't realize the momentum is mathematically exhausted. The rubber band snaps, the stock dips to consolidate, and they are instantly underwater on a trade, while the insiders who sold at 305 are already out.
Yeah, the technical data is making a very strong case that short-term weakness is highly probable here, even if the long-term trend remains positive.
So taking all of this into account, the shift to an infrastructure model, the insider selling, the stretched momentum, what are the actual business narratives driving this? Let's weigh the ultimate bull versus bear fundamental case.
Right, because despite the short-term risks, the bulls have some undeniably massive catalysts on their side.
Yeah, what's the best case recovery scenario look like?
It's built on three massive pillars. First is Google Cloud. Their cloud revenue is currently growing at 48% year over year.
48%. That's insane for a company this size.
It is. That isn't just growth, that is accelerating market share capture. They are significantly outpacing many of their peers right now.
And they are actively building a moat around that cloud infrastructure.
Yeah.
Like the recent strategic acquisition of the cybersecurity firm Wiz. That is a brilliant enterprise play.
Absolutely.
Because major corporate clients, they don't want a patchwork of vendors, right? They want one heavily secured ecosystem, and Alphabet is basically buying the best locks for their digital doors.
And the third pillar directly addresses the AI fears. A year ago, the dominant fear was that AI-powered search engines would cannibalize Alphabet's traditional search and just destroy their ad revenue.
Right, everyone thought ChatGPT was going to kill Google search.
Exactly, but the current data shows AI search is actually expanding their total addressable market. They are finding ways to monetize deeply complex, multi-layered queries that users simply couldn't ask traditional search engines.
So the pie is actually getting bigger.
Yes.
That is a very compelling thesis for why the stock could climb to that $420 target. But we have to look at the bear case, the worst case continuation lower, because it's built on structural realities that are incredibly stubborn.
They really are. We already talked about the $185 billion CapEx pressure, right?
Yeah.
And the fear that AI might just be a low-margin commodity.
Yeah, but we haven't touched the biggest existential threat yet, the Department of Justice.
The antitrust risk. It's a persistent dark cloud over their entire valuation.
Exactly. You can build the most advanced AI infrastructure on the planet, but if the DOJ successfully forces Alphabet to break up its ad tech business, or even worse, forces them to abandon their default search agreements with mobile providers,
the core revenue model takes a devastating hit.
it does. And that ties directly into the macroeconomic headwinds. We really cannot forget that the lion's share of Alphabet's revenue is still fundamentally rooted in advertising.
Which is highly cyclical.
Very cyclical. If inflation persists or the broader economy slows down, the very first thing major corporations cut is their marketing budget. So you have a company spending historic amounts of money on hardware, right, as their primary revenue stream faces severe regulatory and economic vulnerabilities.
It's a perfect storm of risk.
It is. So how do we synthesize these two completely opposite realities? Like, what is the actual outlook for you, the listener, trying to navigate this stock?
I think the most rational way to approach it is to separate the data into two distinct timelines.
Okay, let's start with the short term.
Right. In the short term, meaning the next few days to weeks, the data heavily points to consolidation. Because of that overextended Mexidi rubber band we talked about and the fact that insiders have already taken profits, the market is primed for a pullback. We could very likely see the stock dip down to test support around $311 by mid-April.
So just a necessary cooling off period before it can gather the strength to move higher.
Yes. But if we zoom out to the medium to long-term outlook, looking at the 2027 to 2030 window, the consensus shifts back to highly bullish.
Why that specific window?
Because that is the timeline where those $185 billion in data centers finally finish construction and start yielding those high-margin software returns. Long-term projection models see targets reaching $685 or more by the end of the decade as that infrastructure matures.
Wow. Which means everything hinges on the immediate data we are about to get. The most important data on the calendar right now is April 29, 2026.
Q1 earnings.
Exactly. That is when Q1 earnings drop, and it will be the ultimate catalyst to resolve this tension.
That earnings call is truly where the rubber meets the road. The market will be scrutinizing the forward guidance even more than the past quarter's numbers. We will find out exactly how fast that 48% cloud growth is holding up.
And more importantly, whether management signals any anxiety about their profit margins shrinking under the massive weight of this AI build-out.
Right. That's the real test.
Well, we started this deep dive with a paradox, right? A company printing billions in cash while its own executives head for the exits, and Wall Street simultaneously urges retail to buy in. We've seen how Alphabet is undergoing this massive, expensive metamorphosis from software to infrastructure, and we've decoded the technical traps waiting for the overly eager buyer.
It's definitely a high-stakes standoff between their long-term vision and short-term gravity.
It really is. Which leaves us with one final provocative thought pulled directly from your source material. With all of this conflicting data, the hidden technical traps, and the massive fundamental potentials, the real question isn't just what the analysts say. It's what the market is actually doing with its money right now.
Oh, absolutely.
So would you like to analyze the options chain for Alphabet to see exactly where institutional traders are placing their multi-million-dollar bets ahead of this upcoming earnings call? Because that is where the real truth hides. Thank you for bringing this to us, and we'll catch you on the next deep dive.